This is Zacks Live, the weekly real-time segment when Zacks experts examine key earnings announcements and break down what you should know to prep for what's ahead.
Good morning. Welcome to Zacks Live, the show that's all about earnings. I'm Tracey Ryniec, stock strategist here at Zacks. I'm joined this week by Sheraz Mian, our earnings guru, and Todd Bunton, also a stock strategist here at Zacks. And we're going to find out everything that's going on this week because, as I said, it's really busy. Kind of thought earnings was dying out, but not this week. We got a lot of retail and various other sectors, including autos and tech. And Sheraz, we're going to start with you because we bring you in when we have to know everything that's going on.
Sure.
We're basically at the end of most of earnings now.
That's right.
So how's it shaping up?
Yeah, the Q3 season is effectively over. We are at this funny stage in the reporting cycle where one quarterly period is ending, the other one is about to start. In fact, some of the companies reporting this week, like Adobe and AutoZone, they'll be reporting the November period, which technically we count as part of the Q4 earnings season, but Q3 hasn't officially ended yet either. So as of this morning, we have 493 of the S&P 500 companies have reported results. Total earnings are up 6.8% on 4% higher revenues. 68.5% are beating earnings, 58.4% are beating revenue estimates. Now, the charts that I have at the bottom of this slide provide a comparison of how the earnings and the revenue growth rates and the earnings and revenue beat ratios compare to what we had seen from this group of companies in the previous quarter, and also the average for the preceding 4 quarters. And as you could see, the growth rate, both earnings and revenue, is a tad bit lower than what we had seen in Q2, but about in line with historical level.
Okay.
The positive takeaway, if one was looking for one, would be the revenue growth rate. You would see that a 4% revenue growth rate in Q3 is above the almost 3%, the historical level. If we go to the beat ratios, roughly similar momentum. In fact, the earnings beat ratios are on the higher side, both relative to Q2 as well as the 4-quarter average. The revenue beat ratios are a bit on the weak side, particularly relative to Q2 as well as the and about in line with the 4-quarter average. So the takeaway from this would be that apparently earnings estimates in the run-up to the Q3 earnings season had fallen more than they needed to.
Okay.
And that's why companies very easily came ahead of estimates. But overall, when you look at the growth rates as well as the beat ratios, it's not a bad reporting season. Not great, but not bad either.
And how does it look if we're already getting some people reporting 4th quarter this week? We must have some idea on what 4th quarter's.
That's right. I do have a chart that I want to share with folks about how estimates for Q4 are shaping up.
Oh, but we're going to talk about retail.
So I just wanted to briefly touch about how the big picture for the retail sector has been shaping up. That's been the focus lately. 2.4% earnings growth and 5.3% revenue gains. 58.5% are beating EPS estimates. 63.4% are beating revenue estimates. I have a similar comparison chart here. I compare the earnings and the revenue growth rates for the retail sector with what we had seen from the sector in Q2, as well as the 4-quarter average, and we do the same for the beat ratios too. And you could see the growth rate, the earnings growth rate in particular, is very weak. So it's weak relative to Q2. It's weak relative to the 4-quarter average. Revenue gains, on the other hand, are not that bad. They're actually better, about in line with Q2, and much better than the 4-quarter average. And the takeaway from that is that the sector doesn't really have a top-line problem. They have a margin issue.
Okay.
And this goes back to this highly promotional environment comment that everybody's been talking about. So everybody's trying to over-promote their merchandise at the same time while these folks are dealing with the Amazon issue, the transition to online of all these sales, and then everybody talking about the low foot traffic at the malls and stuff like that, and that's where we are seeing the margin issue in the sector. As mentioned at the top, I wanted to share how estimates for Q4 are shaping up. As you could see, at the beginning of the quarter, the expectation was for a growth rate of 9.6%, and it's dropped to almost a third of what it is for Q4. Nothing new there.
Okay.
The trend has
always
been,
goes down.
that's right. The trend has been there for more than 2 years now. The magnitude of revisions is higher for Q4 though.
Okay.
We haven't seen this level of negative revisions in quite some time. And one contributing factor to that has been the energy sector.
Right, it has to be.
Which has really been hit hard.
Yeah.
So we don't know as to what it tells us. Is it a sign of a further deterioration in the earnings picture, or just the age-old expectations management thing that we have been seeing from management teams for quite some time? I would like to think that it's more of the expectations management team, and nothing really fresh, incremental negative on the earnings side.
So what would happen if we actually didn't see this go down like this? Obviously, they're starting very optimistic every single quarter.
That's right.
But could it ever be that we could see maybe it not drop off as dramatically? That would be.
I would think so. Yeah. If we start seeing not this level of dramatic negative revisions, I think there'll be a very positive turnaround in the earnings picture. We have been seeing this, as I mentioned, for almost 2 years now. Prior to that, companies would, on average, guide higher, or they would give qualitative commentary about the business outlook, which would be encouraging and favorable. We haven't been seeing that in recent quarters. So even though the U.S. outlook has been getting better, European outlook has been bad, the emerging market picture has been kind of weak, the currency position has been kind of unfavorable for all these multinationals, and that's been the backdrop in which management teams discuss the business outlook, and it's been bad. And when companies discuss that, then analysts come in and they cut their estimates, and that's what we saw for Q4 as well, with the added negative being the energy sector's problems.
Right. That doesn't help either.
Yep.
Okay, we did have a big earnings week last week. A ton of retailers reported,
That's right.
various other companies, and Todd's going to share with us a little bit about what happened last week, who were the big winners, who were the big losers. Todd.
Yeah, that's right, Tracy. I have 4 big winners up here, and what gets the companies up on the screen here is not only delivering a positive earnings surprise last week, but also seeing major increases in consensus estimates from analysts. So it's those positive estimate revisions that really can help drive a share price over the ensuing weeks, and it sent these stocks to either a Zacks rank of 1, which is a strong buy rating, or a Zacks rank of 2 buy rating, and the first 3 are all recent number 1 strong buy ranks. Shoe Carnival's on there. You can see they beat last Monday and saw a nice increase in estimates. G3 Apparel, they're obviously an apparel company. They beat on Wednesday the 3rd and saw a nice increase in consensus estimates. Same with Vago, a nice beat on Wednesday. And then Isle of Capri Casinos, they beat on Tuesday. They're a Zacks rank of 2. They saw a nice bump in consensus estimates after they beat. These are the biggest winners from last week. These are companies, if you're looking for more of a momentum play over the next few weeks, stocks that are hot. Not only have these companies beaten earnings and seen the nice increase in consensus estimates, but they've also seen a nice rise in share price over the last week too. So these are kind of your hot stocks right now, stocks you might want to jump onto the bandwagon and ride a little higher. On the flip side, though, there was one big loser last week, and that was Starbolt Carriers. They're the dry shipper. This company, just on the flip side, so they missed earnings and they saw a significant decrease in consensus estimates from analysts and a big drop in their share price. So Starbolt Carriers is on there. And I noticed a lot of oil stocks coming through the screen. Now, these companies didn't necessarily report. Actually, none of the oil companies that that I saw reported last week. They all reported in October or early November, but they're still seeing significant decreases in consensus estimates and significant decreases in the stock price. And of course, that's because of the big drop in oil. So, you know, that's another reason to pay attention to earnings estimates, not just what the company did last quarter. So you can, you know, a lot of these oil stocks still delivered positive earnings surprises for the third quarter, but analysts are slashing their estimates. So it's still an area, you know, I would want to avoid. There are a lot of number 4s, number 5s in there. Estimates are just continuing to get cut as oil prices drop. But you know, on the flip side, it's those retailers that are doing well. So that's probably an area you want to be focused on.
Yeah, Todd, I was just thinking that as you were speaking, I get a lot of questions from people about whether or not, you know, they should be buying the oil stocks now because the share prices are way down. But the estimates are being cut, and the Zacks Rank, you know, is telling us they're 4s, 5s, don't get in. You look at the consensus chart, it's just plunging down. But when is a good time, Todd? Do you think, should I wait till it's like a 3? I mean, when do I think if this is really cheap, or the cuts and estimates are over, or can we even know?
Yeah, it's too early to tell. I mean, the oil stocks, Sheraz probably has a little more insight here, but they're so difficult to read a lot of times because they're so dependent on the price of oil. And you know, I can't forecast the price of oil any better than the next guy. But with value stocks in general, you know, you don't necessarily need to only buy those number 1 ranks that are soaring higher. You know, as a value investor, at least look for those estimates to sort of bottom. So let's say oil kind of bottoms out here in the mid-60s and it just kind of plods along, and you see those consensus estimates kind of bottom out and then maybe start to incrementally inch up as you know, things aren't as bad as they seem. That would be a time to maybe get in and look for that turnaround play or that value play. But wow, it does not look like that's the case right now. You'd probably be too early to that party. So I would just wait, keep an eye on those estimates, and of course keep an eye on oil prices.
I would just add that it's a question of your time horizon.
Okay.
So if you're looking for a tactical kind of trading opportunity now, it's very tough.
Okay.
But if you have a holding horizon that's longer than a year, that's 18 months to 2 years, I think you should be looking at some of these more oilier names, whether it's on the E&P side
okay.
or even on the integrated side. For long-term investors, I think these are extremely good values now.
Okay.
And it's a bit of a contrarian view right now,
yeah.
but those who do listen to me, there's not a lot of them. I have been telling them to go for the Chevrons, to go for the Occidentals.
Okay.
These are very good values now, and the sentiment is very weak on the sector now. But
right.
that's the time when you have to buy these names.
So I should stay away from maybe some of the drillers or the services.
Absolutely.
Side? Okay.
Yeah, the drillers, the outlook for those guys is going to remain depressed for a very long time.
Okay.
So if you have oil prices even inch up into the 70s, you wouldn't have folks leasing drillers or the
right.
oil field service guys, but the producers, particularly for the ones who have more high quality, high valued reserves beyond the Balkans and
okay.
the more higher cost producing regions. Those should be very good. I would go for the big large cap integrateds, also the ones that have good refining and marketing operations, and those should be good. And they're all paying very good stable dividends as well. So
yeah.
So these are good plays.
Okay. Well, good. We give some ideas out there for the oil patch,
That's
but
right.
we got a lot of earnings going on, as I keep saying, this week. It's
That's
still
right.
really busy. We're going to kick it off with AutoZone here, because we are getting auto retailer. They've been really strong. We had
That's
Buffett
right.
going in there and buying some of the small dealership type of companies. Then we're going to get Krispy Kreme on Tuesday.
That's right.
We're getting Costco and Toll Brothers on Wednesday, and then Thursday we're getting a tech company and Adobe here. So it's kind of a diverse group. We are still getting a whole bunch of other retailers too. We're getting Lululemon, we're getting Land's End, there's a whole bunch of others.
That's right.
But bringing up AutoZone first here, chart looks good. Look at, as we keep seeing with so many of these stocks, it's at new 5-year highs. Can autos still, going into 2015, can that still be the sector?
I think it is. Not the broader auto space in general, but retailers like AutoZone. I think they're in the sweet spot.
We still need cars, Sheraz?
We need cars, and Amazon cannot do their business.
No.
This is a very immediacy type of need for auto parts, and if gas prices are coming down, folks are driving more, cars are breaking down more, and you need these parts. So the do-it-yourself segment, and that's why look at the stock price. This is a beautiful chart. Irrespective of what the surprise is going to be, it's been a very strong performer this year. I think the trend should continue for the auto retailers more than other sub-industries within the space.
Okay.
Yeah.
Todd, what does the earnings actual outlook look like? I know you looked into this one.
Yeah. The Zacks consensus estimate for this is $7.17 for the quarter, but I also looked at the earnings ESP, which is our expected surprise predictor, which basically takes a look at the 30-day consensus, so the most recent consensus from analysts, and it's positive, about 0.6%. So the most recent consensus is looking for $7.21, so about a 4-cent beat is what it's predicting. We'll have to wait and see when they report tomorrow if that will be, if it'll be a surprise, but things are looking pretty good for AutoZone here.
That's right.
Okay. Next on our list is Krispy Kreme. The restaurants have been super hot. I put these guys in that category, but they haven't beat since 2013. Shares, all over the place. What's going on? Do you go to Krispy Kreme?
I try to stay away from donuts.
I haven't been there. Maybe that's the problem. None of us go to it.
In my younger days, I enjoyed donuts a lot more than I can afford now. But the surprising thing with them is that they don't sell that much coffee.
Okay.
About 5% of their total sales come from coffee.
Wow.
It's a crazily small number. You would expect them to sell a lot more coffee than they do. If they can find the recipe for making folks buy more coffee along with their donuts, I think then they're in a good business.
Okay. All right. Well, we'll watch this one. I know it's traders like to be in this one, and it's a popular stock, so I'm sure it'll be an interesting report either way. Maybe they'll bust out of this pattern that they've been in. We're also going to get Costco. This has, yet an amazing chart, but look at all those misses.
I know.
It beat last quarter, but it missed all those in a row. No one seems to care. It's surging again.
That's right.
Is this just one of the premier retailers that you have to be in?
It is, absolutely. I mean, this is the best run large cap retailer, and if you have to have any retail exposure, you can't afford not to be in Costco.
Okay.
And that's what you see in that chart.
Yeah.
And it's irrespective of those surprises, whether it's a beat or miss. If I recall correctly, they had very impressive same-store sales numbers for November.
Yeah.
And that's what they come out with. Month after month, they have these strong numbers, which ratchets up expectations so much, which then becomes difficult to manage here. But they seem to have found the recipe where it doesn't really matter whether they beat or miss. I think they're looking good. The one caveat I would mention is that the gasoline price thing.
Right, I was just going to ask about that. They sell a lot of gasoline.
It's about, I believe it's about 10-15% of the total revenue comes from gasoline. So that may start weighing on estimates for 2015, and we'll have to watch that. But overall, retailers of gasoline, when prices are coming down, it's usually good for them, because they don't cut their prices as fast as the wholesale prices at which they buy. It's very sticky. So it helps them grab more margin when prices are coming down than is otherwise the case.
Okay. And maybe we're buying more, not so much with Costco, but the ones that have the convenience store right there. I'm saving at the pump, and I'm like, oh, I'm going to go and buy that soda now.
Absolutely. So they do benefit from the increased purchasing power that comes from lower gasoline prices. So it's that balancing act in their numbers. So yeah, that's a premier retailer that everybody has to be in.
Okay, Todd, you have some information about just earnings on them too, don't you?
Yeah, Tracy, I do. The earnings ESP here is also positive, 1.8%. The Zacks consensus estimate's currently 109. The most recent consensus is $1.11, so could be foreshadowing a 2-cent beat. But as Sheraz alluded to, this company reports monthly sales. November sales were very solid. That was the catalyst behind the increase in consensus estimates. So now that bar's been raised for this company, and as you can see in the stock price, the market has priced it in as well. So it'll be a tough hurdle for them to jump over, but so far it's looking like they'll have another strong quarter.
Okay, we're moving on to housing here. Toll Brothers, the home builders report like kind of all over the place, but these guys are always towards the end, and they're the luxury guys. It's been good for them. I mean, how could it not be on the luxury side? You can see all these beats in a row. Shares have been kind of choppy here.
That's right.
I'm thinking that they're going to probably beat again. The average home price has been rising. I guess the question is, how high can that go?
That's right.
But Toll Brothers has been in some big markets where the money still is. They're building high rises in New York City. Strangely enough, you don't think of Toll Brothers as being in that market.
That's right.
And then they're heavy into California where the home prices are high. So I'm watching the home builders throughout this earnings season just to see kind of gauge that important sector and where the economy is going, because it's kind of going where housing is going. I don't know if you have.
I've been surprised as to how bad the home builders have done stock price wise this year, and
look at that chart. It's
that's right.
That great.
It's been a head scratcher for me. I think the long-term picture for these guys have to be good.
Yeah.
With all the demographic changes, with all the improvement on the labor market front, there's still very reasonable interest rate environment. And when you look at charts for good companies like Toll is, and then you see that in a backdrop where everything else is at record levels, then you have to be mindful that perhaps if you're looking for value, it has to be somewhere in industries like these, and like oil that we mentioned at the top. So I'm not sure what Toll is going to do, and I'm not sure when their fortunes will change.
Right.
But if somebody has a longer term horizon, they have to be interested in stocks like Toll and others.
Okay. And next we get Adobe, and this is another pretty chart, but it is tech. They have 3 beats in a row. Todd, I know you have some earnings info about them.
Yeah, I do. Another positive earnings ESP number here. The most recent consensus is looking for 18 cents a share. The Zacks consensus is 17 cents, so a nice 5.9% positive earnings ESP number. Could be a 4th beat in a row for Adobe.
Okay. Yeah, they're popular. I know they're, people like to talk about them on the chat boards and things like that.
Yeah,
so.
the story with Adobe has been that they're like the classic example of those software producers who are moving from the boxed software package to the online, the cloud thing. And one key buzzword that we keep hearing on their calls and earnings transcripts is the so-called creative cloud.
Okay.
And the subscriptions for those. So it'll be a question of how many new subscription additions the company announces for the so-called creative cloud, and how the margin picture for the company comes across.
Okay.
It is a big cloud play, and it's a question of not only the creative product that they have, but also on the marketing side, the big analytics thing that our marketing people talk about, the omniture and all those things. These are all Adobe products, and and they have a good presence in that. So it'll be interesting to see. Yeah.
All right. Well, all the tech people will be watching this one.
That's
Creative
right.
Cloud. That's a good one.
That's right.
Todd, we also were getting some other retailers this week. As we said, one of our favorites is Lululemon. You and I discuss it all the time. They had the problem with the sheer yoga pants, and then the former CEO or founder saying stuff about, certain people shouldn't wear the clothes, things like that. We won't get into it, but is it, is this like redemption time for them? They have a new CEO, they have new management, they have a new, I think, lead designer. What do you think is going to happen this week with Lulu, Todd?
Yeah, well, from the earnings ESP, I'm not getting a read there. It's so 0% earnings ESP. The most recent consensus is in line with the overall consensus. But Lulu actually has a history of delivering positive earnings surprises, so they haven't missed in the last 5 years. So could be another beat, but what I like to call like a disappointing beat, right? So with them, it's always forward-looking. It's not only what have you done for me recently, but what are you going to do for me in the next quarter? So it's always going to be, what are we looking for and from guidance from the company. But like you said, they've had so many stumbles along the way. I don't know if this is a stock that I would be jumping into, even with the nice tailwinds in retail with lower gas prices and an improving labor market. People's disposable incomes are rising. Overall, I still like the space. And Tracy, I know you and I have talked a lot about Athleta. That's a brand that Gap owns. So they're kind of eating Lululemon's lunch here. But we'll be always watching that guidance and always watching those estimates. So even if this company delivers a beat, doesn't mean their stock price is going to go up.
Yeah, they were the lead player in that space for a very long time, and now that space is getting crowded.
Yeah, they stumbled and they lost the lead.
That's right. And whenever that happens, and you have new players entering your core area, then you have to compete. You have to compete on better designs. You have to compete on prices. That's never good for margins. And when a leading player like them, and we have seen others too, we have seen Coach, we have seen even in the Whole Food, all these areas where competition heats up, it forces you to start competing on prices, and when premier folks like them have to compete on prices, it's never good for the bottom line and the stock price. So it'll be interesting to see if the new management team can steady the ship for Lulu. Yeah,
that's definitely something I'll be watching this week.
That's right.
One other thing just to watch, even though it's not earnings related, is that the S&P 500 has been up 7 weeks in a row now. 7 weeks. Do you think it's going to be 8 this week, Sheraz?
The momentum is behind it. This is the period of the time of the year when everybody is in a positive mood. The Santa Claus really and all that good stuff. So I have been wrong on this market for a really long time. I have no shame in admitting that probably I'll continue to be wrong in the near term too.
Okay, but you just said you think it'll be up. So if you're going to be wrong, then I want to take a contrarian play.
Yeah, no, since I have been wrong, and I'm saying it could be up. That's right. It's probably the Costanza trade is right there.
Right. Okay.
That's right.
What about you, Todd? Do you think we're going to see number 8 this week?
Yeah, eight traditionally has been so hard to get. I mean, this is the strongest rally we've had since October, November last year. But again, yeah, I mean, if you're playing the momentum and historically with December and then all the nice, the strong economic data we got last week, it would definitely be a contrarian bet to say that the market's going to go down this week. But again, you have to look overseas as well. I mean, Japan, they just reported weak economic numbers. Europe continues to be mired in an economic slump, and everybody's waiting for the central bank to do something. So that's kind of the caveat right now, or the biggest risk out there. But if I had to bet, I would say, yeah, we'll end the week higher than we started again.
Okay, we'll have to see. We'll be back next Monday to gauge how good we were at analyzing the ups and downs of the market, and to recap this week's earnings, which will be interesting because there's a lot of retail again, and that's been in the news. If you have any questions, be sure to send them to us at Zacks, at Zacks Live, or live at Zacks.com, sorry, because we will answer your questions, so send them in to us. We're waiting to get your questions and hear from you. So join us again next week, the same time, 9:15 Eastern Time, where we'll talk everything about earnings. Thanks. This is Tracy. See you next week.